pass it over to Neil.
Thanks, Veronica. So now that you've seen a little bit about what ELCs are and what sort of guidance is provided from oversight bodies, I want to take a look at how we would implement ELCs and ultimately test them as well for ICFR purposes. So I just want to begin by talking a little bit about one of the benefits of leveraging ELCs. ELCs really help to lower the risk of transaction controls that may fail to operate. And some of the reasons why transaction controls may fail include employee competencies. Employees may not be adequately trained for their role and therefore can have a failure in controls. There could be poor communication. An organization might have policies and procedures in place, but they may be poorly communicated across all areas. A corporate culture, rather a poor corporate culture, can have an impact in terms of not adequately penalizing instances of wrongdoing, thereby creating an environment where transaction controls could fail. There could be instances where internal controls are overridden by management. I've had experiences with organizations, I'm thinking particularly of a former client of mine, where I was looking at a hospital's procurement process, and they were telling me that there were instances where the procurement process was being bypassed by doctors who wanted to purchase medical equipment, and they were doing so without the proper approvals in place. So that's one method, and just one example rather, in which management can override to a transaction level control. And lastly, unclear roles and responsibilities around what an individual's internal control responsibilities are. ELCs can help lower the risk of fraud, mainly through preventative measures as well as detective measures. Some examples of preventative measures include code of conduct, having ethics training, fraud risk assessment, and ongoing proactive monitoring. ELCs can also lower the risk of significant impact caused by control failure. So one example of this would be, let's say you're recording a journal entry in your GL and it hasn't been approved. So the significance of that and the impact of that control failure could be mitigated by having a strong review process at your period end, reconciliation exercise, for example, to help minimize the impact of that control failure. And lastly, ELCs can help reduce the level of effort associated with transaction level controls, which was a point that Veronica raised earlier. This next slide I wanted to share with you is called, it's a control reliance continuum. And what it sort of articulates is that the focus of reliance on entity-level controls varies according to the size of an organization. And what can happen is that a small organization or a leaner organization with limited staff may have inherent SOD issues or segregation of duties issues due to their size, and therefore could impact the tone at the top. So smaller organizations will have a tendency to rely more on board of directors and senior executives to set the tone. On the other hand, larger organizations that may have in place a robust ERP system, automated controls can be relied upon at the transaction level, as well as organizations that are large but decentralized geographically. And so an example of that could be like a client of mine's like a mining company, and they have operations in North America, but they also have operations in Madagascar. So in order to rely on controls at that level, they're really relying on their line management and their transaction level controls to help ensure that there isn't any risk of control failure. So with this slide, where I wanted to focus was on the control environment. And so what this table depicts is that on the left side, you'll see the 5 principles of the control environment component of the COSO framework. And then on the right side, we'll see some examples of controls that we would expect to see within an organization. So these, again, you may want to think of this within the next few slides as being like a top 10 list, but the only caveat and point that I'd want to stress is that the implementing ELCs is very judgmental, and that goes for internal controls, as well. But in addition to that judgment, they have to be appropriate for the organization. So even though this could be 10 things that you may want to see within your organization, it may not necessarily be appropriate. So just keep that in mind as we go through them. Under COSO 2013, okay, so I mentioned that yes, the left side are the 5 principles of the control environment, and that's where we'll focus. So if we were looking at the first principle, commitment to integrity and ethical values, we would expect to see a code of ethics policy in place. We would expect that the code is approved by the board of directors and reviewed on an annual basis. We would expect that it's communicated and acknowledged by new and existing employees on a regular basis, and that acknowledgement is tracked by the organization as well. We would also expect that it's reinforced regularly through refresher training. Second, we would expect to see, in order to meet this principle, having in place a whistleblower policy. The policy, again, should be approved by the board, should be communicated and acknowledged by new and existing employees, again, supported by refresher training. You'd expect to see it's applicable to both internal and external parties. And that's sort of a weakness that we see within organizations where they may not, they have a whistleblower that applies to internal employees, but it not necessarily speaks to suppliers and customers and the different parts of their value chain. We would expect to see within that policy that any unethical behavior is reported to someone independent of management, which is a critical component to ensure independence. What we usually suggest or see is that someone like the head of the audit committee, who is an external party, would be the one receiving any reports of unethical behavior, and that's a better practice. We'd also like to see within the policy that it's enforced that any reported incidents would be free from retaliation or reprisal, and that's really critical to help ensure that employees feel safe when they're reporting any breaches that they might observe or witness. And then another best practice is to have a third-party hotline for the whistleblower to have it reported externally. Moving on to the second principle under control environment, the independent board of directors. What we would want to see is that there's an active board of directors and audit committee. We would expect to see that there's a charter in place for each, and that charter would comprise of having a purpose and objective. Its membership would be outlined, and it would state that members are to be independent. It would state the frequency of the meetings that are to occur, generally on a quarterly basis is what we tend to find is appropriate. Also the authority level for something, particularly the audit committee and where their authority lies, and how they also report to the board of directors. There are other committees that I've seen at organizations, such as like compensation committees, disclosure committees, health and safety committee, and a risk committee. So these are just some other examples that we would also expect to see, that they would have a charter in place, and particularly for these subcommittees, we would want to see how they report to the board as well. I mentioned that the charter should be reviewed and approved annually, so that it remains relevant. The other emphasis here is on active. And we would expect to see that the board and the audit committee would be actively engaging senior management and challenging them around the decisions that they make, which is a critical component, a part of their role. And then another piece that's important is ensuring that the competency of the members of the committee match their role. So one example would be ensuring that members of an audit committee who are responsible for reviewing financial reporting are financially literate in order to be able to challenge management appropriately. So within the component of structures, reporting lines, authorities, and responsibilities, having in place an internal audit function is critical. What we see or tend to see is that there's a formalized mandate for the IA function, which has been approved by the audit committee. Again, it's reviewed on an annual basis to ensure it remains relevant. As part of its mandate, we would expect that IA, the internal audit function, is responsible for testing the effectiveness of controls and monitoring management's remediation of internal control gaps. Now, that could vary according to the organization. We've seen in some organizations where internal controls can lie within the controller's shop, for example, but if not, then internal audit would assume that function as an independent group. Having in place a formal internal audit plan, typically we see that being a 3-year plan that's been approved by the the audit committee, and it also includes fraud type audits, which is a new part of the COSO 2013 framework. That's a better practice as well. And then to ensure that the audit committee remains open and independent, rather has open communication, is independent to the audit committee, we'd expect to see that the structure in which the function works in is that they report functionally to the audit committee, but administratively to senior management, so that they are able to remain independent and have a direct line of sight and communication to the audit committee. Now, the other thing that I wanted to point out with respect to the internal audit function is that even though we're focusing on the control environment component of the COSO framework, an internal audit function also helps establish the monitoring component as well, because it has that monitoring focus as well. So another control we'd expect to see in the same principle would be having realistic targets and budgets which are established. So annual budgets and targets would be established. We would expect to see that budget to actual reporting is generated and reviewed by management on a regular basis. Typically, we would assume that this is done monthly, but it can vary according to the organization. I wanted to emphasize here on having realistic targets, and the purpose of that is creating a culture where short-term targets are taking a priority over longer-term, more strategic targets. Can sometimes create a culture where employees might undertake unethical behavior to meet short-term results. So that's a critical piece. We've seen instances where organizations going back to like Enron and WorldCom focused on short-term gains, and that then had an impact on the type of behavior that their managers would So the last control that we would see within this component is having in place a delegation of authority matrix. We would expect that the authorization or limits, the limits are appropriate for all personnel within the organization. We would expect that it's been approved by the board of directors, and that it's communicated to all employees and is easily accessible. So moving on to the fourth principle, attracting, developing, and retaining competent employees. We expect that the finance staff would be hiring the right person for the right job based on their qualifications. We expect to see that they're provided ongoing training as necessary, and that in the event that expertise doesn't lie within the organization, a finance group would then reach out externally to get the type of additional skill sets that they need. So one example of this might be, and I've seen this in organizations, where they reach out to their external auditors for gaining more additional information on complex accounting matters. So IFRS, GAAP, depending on the nature of the issue. But that's one thing that we would also expect to see. The second piece here is keep the bad guys out through comprehensive screening. Sounds simple, but helping to set the tone of the control environment involves bringing the right people on board. So we would expect to see that references are verified when hiring new employees. Criminal checks are performed as well as credit checks are performed. And for the last principle of holding people accountable for internal control, we would expect to see that job descriptions are, of course, in place, but that they also speak to the type of internal control responsibilities that each person is responsible for. And then the second piece would be having an alignment between the ethical values of the organization and incentive programs. So the focus here is really on compensation. I go back to the example I gave before about creating the right culture. If compensation is tied to short-term results, you're going to have illicit behavior.